I'm blown away by this. So many of the people that I ask that question have a similar answer. And it's basically like, how many people can I affect in a positive way? And it's just so cool to hear that. And it's I don't know what else to say besides I really love and respect that answer. So I appreciate you taking the time to think that through. It's so cool. I completely agree. I mean, money will come and go, and financial success is one piece of a very large puzzle. And it's in my opinion, one of the smaller pieces.
Welcome to the Real Estate Mindset Podcast, hosted by Eric Nelson and brought to you by Wild Oak Capital. Eric is a real estate investor, business owner, and performance coach. Throughout this series, Eric explores the mindset behind why certain investors are so successful and how we can learn from their achievements and failures. Eric asks the tough questions around the habits, discipline, mindset, and more required to achieve the most ambitious goals. Thank you for being here and enjoy the show.
Hey everybody, welcome to the Real Estate Mindset Podcast. This is your host, Eric Nelson, and I'm really excited for tonight's guest, Larry Pendleton. Thank you so much for being here. Appreciate your time, and I can't wait to talk with you.
Appreciate it, Eric. I'm grateful to be on.
Yeah, we were just discussing in the pre-show that it's tax season 1 and 2. It's pretty late on the East Coast, so really appreciate your time. Thanks for jumping in, and hopefully I won't keep you too long, but I can't wait to ask you a few questions. So we can just jump right in. I think let's start with the beginning. So tell us about your background, what you used to do, and then what got you into real estate.
Okay, thanks again for having me on. I'm actually born and raised in Norfolk, Virginia. Still here to this day. Always had an interest in cash flow and how money works in general. But the concept of accounting and whatnot didn't really hit me until until high school, and we had a accounting class. That the only reason why I joined it because the teacher, I had a crush on the teachers. So
that's so good. That worked out.
It didn't work out between us two, but I was able to learn some stuff and kind of took the the rich dad poor dad traditional route of go to school, get a job, and kind of work up the corporate ladder from that standpoint there. So that's what I did. I said I spent about 8 years in public accounting on the tax side, as well as in audits as well, public companies, private companies, and then spent another 3 years in internal audit for public and private companies, international companies as well. And during that time, I actually opened up PC Financial Services, which is my tax consulting preparation company with my partner Terry on Conyers. That's been roughly 7 years now of running that. And ironically enough, as I tell people, I always knew the benefits of taxes from a real estate perspective, and always recommend that for my clients, but I never did it for myself. And I believe it's more of a limiting mindset aspect. I just didn't think I can own property and run it. And it's one of those weird things where my partner Terry on he actually had a rental portfolio and had a few houses, and I could easily ask him how he did it, and I just never did. But roughly 5 years ago, he had basically too much on his plate, and it was Larry, basically put the property in my lap, told me about FHA loans, and then ran the numbers. Like I said, only 3% down, and I still had that property to this day, cash flowing roughly $300 a month. And being able to refinance and use that money to invest in other deals. So I've been hooked on it ever since. Done some flips. Not really my thing. Got my own horror stories, as we all do, regarding that. But either way, it was just kind of learn more hey, what's my personality, what fits me, what in my skill set from that standpoint there. So just slowly kind of one property here along the way, and then just saw the scalability of just kind of doing the small single family aspects. Like, okay, this really isn't going to work for someone who's uh, has kids, and I mean, for me, I guess as I said, for me, it didn't make sense for me. And then in 2018, um, came across Michael Blanc, just researching just different real estate strategies, and actually came across like, okay, you can actually get into multifamily and have multiple incomes under one roof from that standpoint there. And I just kind of took that along with, because most people kind of see it from a like like pre-tax return perspective, which is good, which is still important. But I'm also seeing it also from a post-tax perspective as well, because I'm in that world and I kind of see like, hey, using depreciation and how rental real estate is per se passive, and kind of just build from there. So, I mean, 2019 was a really good year for us. Like, able to acquire 5 properties between duplexes and quads before the market really started to turn and prices started to rise up on us from that standpoint there. But just kind of building that network, going to different events, uh, whether it's multifamily masters, multifamily matrix, connecting with people, different people from Rob Khalid's Warrior program. This constantly kind of putting myself out there, just meeting more people to a point where, like, okay, I was able to close on a 16 unit last year in Newport News, Virginia, and connect with a great team of Rise Equity to close on a 20 unit in Cummings, Georgia this year. And like I said, now trying that whole law of the first deal, and now that you get under your belt and kind of see and letting it snowball from there. And then during this time over the past 2 years of kind of observing like how my time needs to be best spent, is with the networking is, okay, how is my tax business kind of aligning with that? And and there was one point like I almost burnt myself out because, like I said, I was just doing the standard route, just a whole bunch of taxes and trying to make it a business out of it. It's like it was almost like this isn't going to work for me. But like my mentors, just like when you're in real estate, you're always answering questions from people in real estate about taxes. Like, why not work with just primarily professionals in real estate? And it like light bulb, all that went off, and so like now I primarily serve uh, professionals in real estate, and that's how I kind of market myself as to that point. So, because at the end of the day, I tell people like what I recommend is stuff that I have done. I either have done, I plan on doing, or I know in great detail, but I don't really go down that route because I'm not a wholesaler or agent or flipper, but I understand like what the tax strategy from a real estate perspective it can be. So that's where we are today, where the tax side kind of rolls into supporting the networking and building of partners from building my own portfolio as well.
Awesome. Well, Larry, there was so much stuff in there that you said that was so good. I kind of want to break a few of those things down. So, first off, sound like you had a flip like many people have. I mean, flipping on TV looks super easy, right? But it can be a challenge. But I love your attitude. I love how you were like, you know what? That's not for me. I'm going to figure out a strategy that works for my style. I mean, because lots of people quit, they'll do one and have a bad experience and say, nah, that'll never work. And then it's interesting that you said limited mindset in regard to real estate. It's so funny how you can give advice, something is good, but you don't actually take that leap yourself. So pretty neat that your partner kind of pushed you into one, and now the ball's rolling. He like pushed you down a hill that you were
Yep,
looking down.
definitely.
Yeah, and then I love, I love multifamily masters. I love the same things that you do. I mean, just kind of getting to know people, and that's part of the business is networking and get to know great people. So appreciate you kind of opening up and telling us your whole story. So you touched on it a little bit on depreciation, but if you're ready, I think we can kind of dive in a little bit deeper, and can I
Mhm.
ask you some specific questions in regards to tax? So I think what I want to do is pretend basically we're a passive investor. Someone might be investing in one of your syndicated deals, for example, And maybe we
Mhm.
ask some questions, pointed questions around that. So let's say, for example, you put $100,000 into a deal. Let's say you make a pretty good return. What can you expect to see on your tax return, the year after that? And you hear a lot of numbers, you're like K1 and 1065 and all that stuff. So can you kind of break it
Mhm.
down a little bit for us? If you're a passive investor, not super knowledgeable about this, what can you expect to see, and what can you roughly expect to pay? I know every situation is different, right? Maybe we
Mhm.
give the disclaimer now. This is not legal advice, and talk to your personal CPA. But yeah, I mean, just
Yeah,
kind of like a good rough example. That would be awesome.
yeah, definitely. It's definitely a full disclaimer, like not legal, and this is really more just informational purposes from a accounting tax perspective. But yeah, so if you're a passive investor and you kind of been researching different deal sponsors and they bring an apartment building deal to you, and just hypothetically say you put in 100,000 into that deal, like you're most likely one of many or a few, I should say, passive investors that's in that deal from a limited partner perspective. So this is going to be an LLC setup, and then depending how the deal is structured, you're going to be receiving distributions back monthly or quarterly from that standpoint there. So part of that. So the 100,000 is basically your capital that you have into the property itself, and then the distributions, and most likely is an equity split, or maybe a preferred return involved as well, where it's kind of guarantee a certain percentage payout per period until um, the passive investors are somewhat met their returns. But so you're going to be basically receiving income or distributions or basically a split of the equity back because there's an equity split on a monthly quarterly basis. So you may get 12 of those a year, you may get 4 of those, depends on how the deal is structured. So what most people mind, they think that okay, I made this income per se, am I going to be taxed on this income? And it's never just a clear yes no answer. What people really have to remember is like you're just one piece. What you're paid out is just one piece of a bigger picture. Like you've been paid out your portion of the equity per whatever income that's made or how the deal is structured. But at the end of the year, but the property is still being ran as one whole business. So the income's coming in, expenses coming out, and then at the end of the year, the deal sponsors are working with their tax professionals in order to calculate depreciation, get certain write-offs in, so that when you receive your K1, which is basically from the business tax return, that everybody that's a partner, limited or general partner, is going to receive from that standpoint. So it's going to probably may or may not show what your capital contribution is, and it's going to show your the distributions that you receive, but there's going to be a net income from the rental activity itself, and that can be a positive number, that can be a loss. That all depends on how that property was operating as a whole. More times, uh, more likely than not, if it's a loss, it's more likely because depreciation was factored in. The property was, I mean, maybe in year one it was probably operating at a loss because of it was a heavy value add or a lot of renovations that were needed. Um, but years after that, it may even be like a loss or very little income to show because you have depreciation being factored in, and then what and as I try to explain to people, depreciation is basically an incentive of the government to get people to invest into uh, rental properties. The government wants people like needs housing for the masses, and to incentivize investors to invest into real estate, from a rental perspective, they offer depreciation, allowing you to make up the cost of the building over a certain number of years, and other items as well, other properties as well. And the reason why is that because the building itself is an income producing asset. It's not an expense. We just can't write off the whole value of the building, even though most investors will probably argue that should be the case. So the government's basically okay, investor, if you're going to buy this property, you're going to buy this 100-unit apartment building. Okay, you're allowed to write off a portion of that, which is now considered a paper loss over a certain amount of years, and then that's reflected onto the business tax return, and then everyone's percentage portion is allocated out on their K1. So the income that you receive is now basically you're not really seeing that. You're seeing the loss that you're having to report on your personal tax return, which is always a good thing. And then, like I said, we can get into the weeds of whether or not you're able to even recognize that loss on your personal tax return. But I guess for the purpose of just kind of answering your question of like what are they seeing when they talk about the 1065? That's the business tax return, and then what's produced from that are K1s that each partner, general and limited, are receiving from the business, and it's just basically the profit and loss, and then the allocation of what that the net income or net loss is.
Awesome. So if you're a passive investor, you can expect to see a K1, and assuming that, depreciation factored in, and assuming it's not this crazy heavy lift early on, a lot of times you
Mhm.
might even see a loss, is what you're saying, on your tax return, which you may have received distributions throughout the year, but essentially your tax burden at the end of the year a lot of times is zero, or even perhaps helps you. Is that basically correct?
Yes. So
Okay.
basically, you're receiving income that either you're not going to be taxed on because is either breaking out at zero, or you potentially could like lower your own tax liability because there's a loss, and depending on what your adjusted gross income is, if you qualify as a real estate professional, so forth, and so many things where like you can actually use those losses to offset your non-passive income, W-2 business, from that standpoint there.
Okay. And then what happens at the exit? So is that depreciation recaptured? And then what can you expect again as a passive investor? Let's say you sell the property, and let's say they're, we won't get into cost segregation. Let's just assume that they're doing a kind of a standard depreciation model. You sell the
Mhm.
property. Do you essentially have to kind of pay that back, or how does that work? Especially as, again, from the passive investor perspective.
Right. So let's go back to the setup of you are basically partnering with the government to provide housing to the masses, and to incentivize people, the investors to do so, they offer depreciation. If you sell the property, you are breaking that contract with the government. And that's just basically how I like to explain to people. So at that point, the government's like, well, if you're going to break this contract, all the depreciation that you claim it benefited from, we want that back in the form of what's called depreciation recapture. So basically, at that point, if you bought the building for $1 million, or the deal sponsor bought the building for $1 million, let's just say during that time period, $500,000 of depreciation was claimed, just using simple numbers for the purpose of
Sure.
this conversation, and the building was sold for $2 million. So you think it would be a $1 million gain that would have to be uh, taxed on. That's not the case when you're talking about depreciation. So whatever depreciation that was claimed throughout those years, that's going to bring down the basis of the original cost of the building. So that 1 million now turns to 500,000. You still sold it for 2 million. So instead of that $1 million uh, capital gain, you're now looking at 1.5 million dollar capital gain that you have to pay taxes on as well. And then, of course, all the investors that's involved, everyone gets that particular portion. And depending on the deal sponsor that you're dealing with, there are ways to mitigate that. If you stay with that sponsor, like they may want to 1031 it into another deal, or they may be able to acquire another property within the same calendar year, so that they can offset those gains with the losses that's going to be created by the new property. If you stay with that sponsor, if you decide to basically cash out, then you have to find opportunities to but you have to deal with those gains of your portion of the gains yourself, And you can still do that whether it's investing into another syndication, or you may have passive losses built up because you was unable to use them in previous years because you're a high net worth individual. So like those passive losses can offset the gains, especially the depreciation that's been added back, or I guess brought down the basis of the building.
Okay, so a couple things, and we won't get too far in the weeds, but that kind of does bring me to my next question. So we'll come back to 1031. But when you say kind of build up your passive, or yeah, your losses, can you elect to kind of build those up even if you could use them? Does that make sense?
Yeah, so you don't have to use, so like if you're able to tap into your passive losses, like you could elect to not use those in certain years, in this kind of, especially if you're planning on um uh if you know when the sale is going to happen of that building. It's not really a strategy uh that I utilize myself because I'm always in the mindset of the time value of money, what the dollar is worth now. So we're able to use losses now, and be able to claim whatever we can. Like, let's go ahead and use those now, because the premise of investing in the real estate is that you have to keep going
Right.
until you can actually trade out from that standpoint there. So holding on to losses for 5, 7 years may not make sense if you like, especially go ahead and claim what you can now. You don't know what the laws may change, and you're still actively looking for something else to invest into that's going to help generate more losses. That's going to help offset gains from the sale of other syndications that you may be in. So it's almost a timing aspect of it while being aggressive with cash flow and wealth generation as well.
Okay. And so let's dive into 1031 a little bit. Can you explain, again, top level what a 1031 exchange is? And then, you mentioned kind of sticking with the sponsor, but let's say you exit the sponsor and you want to do something else. Can you leave a syndication and jump into like your own investment, like a JV, and use that as a 1031 exchange? So I know I gave you a lot. So we'll start with 1031 at the top level.
So 1031 is basically a like kind of exchange. So basically, the government saying if you can defer the capital gains tax if the sale of a property, or a sale of anything, if or let's just say a sale of a property, if you're rolling those gains into another property. Now with 1031s, there are time constraints of when you have to identify the properties, 45 days, and then when you have to actually or identify a number of properties that you may want to acquire, and then you have 180 days until you actually have to close on that. So it creates a bit of a time constraint from that standpoint. You have to work with a third party custodian that's independent. You just can't use family or even your accountant per se. Like, it is, someone has to be independent from you in order to be able to roll those gains over. Pretty similar to if you were rolling over
Like
a
an IRA,
retirement account,
maybe. Okay. Yeah.
IRA. Like you can, like, even IRAs, you have, like, even if you take the money yourself, you got 60 days until you got to put into something else. But if you still have to use some type of custodian to kind of maneuver the funds from that standpoint there. So that's what basically a 1031 exchange is that it's allowing you to roll those gains from one property, from the sale of one property to the acquisition of another property. The problem, I won't say the problem, but a situation that comes up with passive investors is that with 1031s, the entity that bought and sold the property, the entity that sold the property has to be the same one that's buying the new property. So if you're exiting a syndication, you're no longer part of the entity that sold the property. So you're not going to be able to 1031 your portion of the gains into another property.
You're not allowed to
Now,
use that. Sorry.
there's ways, I won't say around it, but I'm sorry, go ahead.
I said, no, you just said you're not allowed to
Was there a
exit that.
question? I'm sorry, I mean,
No, no, no. I think we're lagging a
but
little
you're
bit.
allowed to exit that. Oh, can you hear me?
Yeah, yeah. I think we had a little lag. No worries. So I was saying you're
Oh,
allowed to exit, but can you 1031 It has to be the same entity. So you couldn't purchase another property with those gains in 1031 on your own. Is that what you're saying?
You can, but it would have to be something they call a tenant in common, and it's a very convoluted, messy procedure. That like it's not and it's cost like it's not worth the cost and the hassle for the individual that's moving the funds, and also for the deal sponsor that's bringing in those funds. So that there's very little opportunities for using a 1031 if you're a passive investor, taking your portion of the gains and put them into another property. Now, you could like there's another way of looking at it where you can create quote unquote your own 1031 exchange by okay you X like let's just say they sold the property in February of whatever year that we're in, let's say in 2021 they sold the property then. If you able to invest into another syndication before the end of that calendar year and they are able to provide again losses that on the K1 that can help offset the gains that you receive from the sale, you in a roundabout way create your own 1031 from that standpoint. And so there's not really there's no real name for that. It's just timing of when the sale is going to happen versus when you can actually acquire another property. And you may not have that control over that because you don't know when your deal sponsor, but you're going to know, but you may not have any control of when the deal sponsor will sell that original property. They may do it at the end of the year. You may not have enough time to put those gains into something else that can offset. They can have the losses to offset the gains.
I love that strategy. And the cool thing about that, if I'm understanding it correctly, is you don't have to have a custodian either. I mean, you could do that essentially on your own. And it's kind of a made up 1031.
Yep.
But that's a
Yep.
very cool strategy. I'm glad you brought that up. Um, so could the general partnership essentially, let's say that same entity sell a property and then the entire entity more or less 1031 into another one? Is that possible?
Yeah, that's possible. That I mean, it has to be all coordinated with all the passive investors on the deal. That okay, if everybody wants to stay in the deal, we're going to take these gains and we're going to roll it into this next property. So basically, they're already reinvesting the funds that the passive investors would have reinvested into another deal anyway, without having to uh, receive like take out everything, receive a K1, and then put everything back. So it's like, okay, we're just going to take the same group. We got this much in gains from the sale. We know it's $1 million gain, and then we're going to put that into this next deal and defer the gains from there.
Okay. And then let's maybe take a step back and just talk about like a really simple example, maybe like a single family home. We'll forget syndications for the moment. So let's say you purchase a property for $100,000, you sell it. And then my understanding of a 1031 is that the basis has to be higher in the new purchase than your original one. Is that correct?
Yes, equal to higher to the basis of the original property. Yes.
Okay. And that basis is essentially what you purchased it for, not necessarily the basis from depreciation. Does that make sense? So it has to be, no matter what, over $100,000. Is that right?
Yeah, so basically the unadjusted basis, because the adjusted basis would include depreciation. So they know they're saying like if you're basically with the 1031 it's saying you're required to trade up,
Got it. Okay.
almost like almost like monopoly at that point. The whole four greenhouses in the red hotel, or is it red houses in the green hotel? I can't remember, but it's basically monopoly at that.
Got it. So, I mean, it's kind of the same thing. I mean, you're entering this agreement, you're providing housing, you made a profit, they want you to get that tax benefit. They want you to buy something as much or larger. You can't take a piece of it and run type thing. So I just wanted to clarify that for listeners. Maybe someone's buying a single family and then they're selling it. This is a very powerful tool. And again, there's time constraints. So absolutely talk to your CPA and get a custodian in order. I heard a custodian kind of tell a bunch of horror stories where people will close on the property, sell it, and then come to them and say, "Hey, I want a 1031." And he says, "Well, sorry, I can't help you." So you need to kind of get that lined out before you actually exit the property. So I think that's pretty good advice, at least for me. Really appreciate that. So, Larry, this podcast is based a lot around mindset. I love that we dove into this stuff. Really powerful tools for listeners. But what I like to do is basically completely shift gears, and I have a list of questions that I ask every guest. And so, if you're ready, we'll just dive right in.
Let's do it.
All right. So the first one, man, this is way off from what we were talking about. But first one is, do you have a morning routine?
Yes, I get up at 3:45 Monday through Friday, and I'll say like about 4:30 on Saturday and Sunday. I spend about uh, 5 minutes. I mean, just kind of getting the body moving a bit, but 5 to 15 minutes of just meditation, uh, just gratefulness, focus. Um, do my workout, and then start preparing my boys breakfast. So
Yeah.
that's my morning routine.
So, what time are your kids kind of getting up, more or less?
Uh,
Depends.
it's a crap. I would say 5:30 is when it's kind of the norm. So we can
I
help
was
get them to sleep in.
Yeah, no, I was just I was asking to understand like your time that you have from when you get up to when the boys get up. So this is really funny. I mean, we talked about again on the pre-show. You have young boys and I have young boys, so feel like we have that similar kind of concept where, yeah, I get up pretty early, kind of similar story, and then you never know when they're going to wake up. But I think it's super super powerful to have some time before that and really prep myself to be a good parent, good person, and kind of get that going. And I love the gratitude, like you said. So very cool answer. Okay. The next one would be, what books are you reading, or what books can you recommend for people to read?
Besides tax books. um,
Those sound really
uh,
fun.
I've been a big fan of Tribe of Million. Actually, Tribe of Millionaires is one recently wrapped up. One that I did earlier this year that I constantly just been pushing out to a lot of people to consider is Who Not How. I don't want to get the author's name wrong, but I believe it's Dan Sullivan, but I think I got the name wrong.
That's all right. We'll
But the
put it in the
book is
show notes, so it's all good.
yeah, yeah. So Who Not How is is the book that like I'll read that one probably 3 4 times a year. Uh, just just from a mindset perspective of like how am I aligning my goals, how am I building my teams, how I'm putting the right people around me from that standpoint there, so I can focus more on my strengths instead of my weaknesses.
Super good. Yeah, I appreciate those recommendations. So the next one is, do you have a coach or a mentor? I heard you mention Rod Cleve's program. I mean, do you think it's been worth the investment? And would you do it again?
Well, I'm not in directly in that program. I just know a lot of people that is in that
Oh,
program.
okay, okay.
One of my coaches is like Garrison Gilbert, and he's one of Rob Khalif's coaches, and then um, Garrison has his own. So like I've the investment into that, and then just being able to connect with other coaches locally around here, where um, there's not an actual dollar that's paid out to them. Is more of okay, the tax consulting advice from that standpoint, almost like borrowing services at that point.
All
Where
right. Are you putting those on your tax return? Just just kidding. We won't tell anybody. uh
but yeah,
that's
like,
good. No, I
definitely
mean,
something like yeah, just trade information is like okay, they can explain different parts of real estate to me from their perspective, especially those are kind of in the development world that I'm looking into now. To okay, here's the from the tax side how they need to be kind of looked at and considered from that standpoint. So
I love that answer. The reason I ask is because I have been pretty sold on coaching. I have a coach myself, and I just get so much value out of it. So to each their own, right? I mean, I'm not saying everyone has to, but I just asked that question because for me personally, it's been pretty powerful. So I appreciate that answer. And the next one, um, Daisy and Luke, this question started as what's the biggest mistake you've ever made that, that we can learn from? And Daisy was pretty fun. I mean, she corrected me. It was like, it's not really a mistake. It's kind of a learning opportunity. So what's something that we can learn from that you wouldn't repeat?
Ah, man.
Nothing. You can say nothing. You crushed it up till now.
No, no, I'm just trying to think of which one.
Well, how about you could give us a quick a story about your flips? Is that, I mean, I heard you say on other podcasts you have like a horror story, but you can just say briefly. Maybe that's an example.
I mean, the thing with the flip, and the one thing I'll always say, I learned the value of like, okay, I'm not good at this. Um, budgeting, um, well, I think my internet is kind of going
Yeah,
a
I
little
think you kind of.
wacky.
Yeah. Well, let's start over. So we can cut that little part. So you were saying you
Yeah,
learned what I heard was you say you learned the value.
yeah, value of just having the right team, having the right contractors in place, not going the cheapest route. From that standpoint, there was okay, like we could save so much like money, save so much like stress and headache just by taking the time of okay, the returns on this doesn't like may or may not sense if we're going to bring in a certain number of people on this deal. But depending on the deal is okay, do we have the right people on it instead of the cheapest thing to maximize the returns. So that's the one thing I'll say. If I had to go back and correct, like actually taking the time is like, okay. Let me build out the right team, which would have saved like beyond the money part, just the stress and the mental and physical and family strain that it caused.
Yeah, I appreciate you being honest and open about that. Thanks for sharing. Okay, so the next one would be what, and you've already given a lot, but what mindset tips can you give someone starting out, that they can take to propel? What can you offer as a tip?
Uh, remain grateful and positive. Like every opportunity, to be mindful of how you speak about yourself. It's something I work on a lot, where it's like not being so negative, even from a joking perspective. Is like no, it's staying positive, like knowing what I'm good at, and then being grateful for that strength that I have to do those things, and then being grateful for the people around me, um, and, and staying positive with them of their strengths, and then that just kind of breathes life into everybody, including yourself from that standpoint. So just remaining grateful and positive about like any scenario, any situations. I know things are tough in the world now, but it's still finding those opportunities to remain grateful and positive.
Oh, that's so good. I really love that answer. That kind of hit home. I mean, that's really cool. So thanks for sharing. Um, and the final one is, if someone asks, well, that's kind of a two-part question. If someone asks, what makes you successful? What's your answer to that?
I the shirt that you see me wearing, like I wear t-shirts when I go see clients. Like I'm a very nonchalant, like I'm not the suit and tie tax guy. So I think just the being able to put people at ease when it comes to taxes and kind of just breaking it down and being real cool and mellow about it, like that has led to a lot of my success. Um, because you can be like it's a different kind of confidence when you're just kind of flowing through the information without being so buttoned up and narrow and strict. Especially when you talk to people who have huge tax bills. It's like it's going to be all right. We can do this, and we can we can set up this strategy here, and keep a smile on the face at the same time.
Oh, that's so good. All right. Well, the second part of that is, what is your definition of success?
um, I think just the number of people that you can serve and help from that standpoint. I mean, I mean, money's going to come and go. And we're all into real estate a lot of times, really more for the freedom, but the fact that you can help push society along and help those who, from whatever skill set, I know mine is helping people reach financial freedom through real estate and taxes. Like that's something that I tell myself every night and every day before I go to bed and when I wake up. So the more people I can help in that standpoint, they may not be clients, they may not be any of my deals. Is that they may just heard me talk and then they're able to kind of take it and go from there. Like, okay, that's successful for me to be able to pour into other people and see them thrive off of whatever I'm doing that can get them going.
Yeah, such a good answer. I mean, I'm blown away by this. So many of the people that I ask that question have a similar answer. And it's basically like, how many people can I affect in a positive way? And it's just so cool to hear that. And it's I don't know what else to say besides I really love and respect that answer. So I appreciate you taking the time to think that through. It's so cool. I completely agree. I mean, money will come and go, and financial success is one piece of a very large puzzle. And it's in my opinion, one of the smaller pieces, right? So money is a tool, but it's a tool to be used to help people, in the long run, or maybe not help people, but to do good, make this place we live a better place. So that's my perspective. I don't want to jump on your toes, but I really, really respect that answer. So well done. So that's pretty much it. You're out of the hot seat. You're out of the hot seat. So
No, no, I just want to kind of add one thing because people always kind of go back and forth between cash is king or cash is like what like and from the aspect, and it's something I saw as a picture where they actually had cash as the pawns to buy the real queen of the chessboard, which is the asset, and the queens produce the kings, which is cash flow, and it's a cycle. So the queens produce the cash flow builds up the cash so that you can buy more queens. So that's why I said where so the money comes and goes because it's literally or it's the pawn of the whole game because you want cash flow and you need the queens to be able to build the cash flow.
yeah, that's awesome. I love that picture. I haven't seen that, so I'll go dive in for it on the internet tomorrow.
Yeah, it's awesome. I'm trying to see if I can get a shirt made
There you go.
to show it.
Okay, cool. So how can people connect with you? And now's a good time. And if you want to pitch, you already mentioned PC Financial Services, Rise Equity, anything you want to talk about, but can people find you, social media, websites? How can we get in touch?
Yeah, I'm on Instagram, I'm on LinkedIn, I'm on Facebook. Larry Pendleton CPA. I try to make myself easy to find. I'm taking the Gary V route and just throwing my cell phone out there. So 757-535-8592. Like text me, call me. If you call, I'm not going to answer because I don't recognize your number. But please leave a voicemail so I can call you back. But I definitely want to just kind of reach out. Like if people want to reach out, like I'm happy to talk stuff through from a mindset perspective, from a tax, real estate. I like the aspect of meeting more people and growing from that standpoint there.
Yeah, Larry, I love your enthusiasm to help people. Really appreciate your time being here. Thanks so much for taking the time to be on.
Appreciate it, Eric.
Thank you for listening to this episode of the Real Estate Mindset Podcast. If you've enjoyed the content today, please follow this show wherever you listen to podcasts. And don't forget to head over to wildoakcapital.com for more information or to connect with Eric directly. Please take a moment to leave a review or tell a friend about what you've listened to today. We hope you'll tune in again soon.